Let's get more now reaction to Apple's quarter. Joining us is legendary tech investor Paul Meeks. He is a portfolio manager at Independent Solutions Wealth Management. No doubt going through the numbers, no doubt listening to our commentary on Paul. Listen, Paul, you know, we've been talking for what, 15 years, you and I? We believe that the numbers tell the story. The stock's up 2%. Therefore, the market likes it. Is there anything, though, that you could find in anything you've seen that is cause for any concern around Apple?
I think you've already hit on it. The slight deceleration, even though on an absolute basis it's still growing robustly in services, is somewhat worrisome, because if you want to have a software and services play, you can find a pure play software and services company that's growing faster and has higher profit margins. And then the other thing I worry about, Brian, is nothing to do with what was reported today, nothing to do with what was reported today with the guidance. But even after I suspect this company will earn $14 per share this year instead of 13 plus, you still are trading with where the stock is moving after hours tonight at 23 times. That's pretty rich.
Where one of their biggest markets is facing the worst sort of viral outbreak in at least 15 years with the coronavirus. So we don't know.
I absolutely think that's the case. And not only the coronavirus, you know, one of the real catalyst to this story, to have it re-rated higher as far as its PE ratio in the last 12 to 24 months, is a hopeful lesson. Where in the quarter just reported this evening, iPhone is up over 60% of total revenue. In one sense, that's great for the short term. In the long term, we do know that despite this bump, which we'll see probably even a greater bump in the short term with a 5G rollout, smartphone market, not just in the States, but around the world, except for very few emerging market countries, is a slow growth market. It reminds me of something that we saw with PCs. PC at home, in your pocket, and at the office, you didn't need another one, and then units started to fall. Remember, the backstory is smartphones are a mature business, 5G liftoff, which in the short term would be great. Long term, I'm very worried.
Hey, Paul, it's Tim Seymour. What's might happen in the future, the forward multiple? I want to get to this because you're someone that's managed stocks through some frothy times, and you know, so it's 23, 24 times next 12 months. You talked about software companies that trade at much higher multiples, by the way, that you could get more growth in. But you know, what's the multiple for this stock in a low interest rate environment? Because isn't that what it comes down to at this point? It's re-rated so much.
You know, I think the fair multiple is not 23. I think once you clear the 5G boost, I think over time this stock should probably trade at 16, 17, 18 times earnings. And so, yes, we'll have upside EPS. So we'll have higher EPS to multiply with the PE ratio. But I think that's fair long term rather than something that's mid to high 20s.
And we're kind of going on the fly with this here, Guy. And I'm looking at the numbers, and I guess we're not trying to poke holes, but if you got to find something where you've doubled your money in a year, you're kind of looking. Apple noted, and I might tweet this out, that their net sales fell fractionally from fiscal 18 to fiscal 19, and they said in part because wearables may have looked like taken some of the sales. You know, you'd rather sell an $1,100 phone, I assume, than a $270 pair of AirPods.
Stands to reason. Look, I mean, this is a good quarter. Apple's had, you know, Dan talks about it all the time. You've basically had flat EPS growth for quite some time now. You've had multiple expansion, and that's what Paul was just talking about now. I think, you know, for Chris Verone, who's been correct and bullish in terms of tech, semis, and Apple for a long time, to say, you know what, maybe this sort of crescendos after a quarter like this, I think you have to take notice. An 18 multiple on the earnings they're expecting gets you to the level that Chris just talked about, roughly 275, 280. I don't think that's unreasonable.
And Guy, I would add there, the one number I think people have to focus on is 304. That was the low in the stock yesterday when all the anxiety and all the stress about the virus. You start to break 304, I think it risks a deeper drawdown. I would say that for a lot of names, whatever their lows were yesterday are important short-term levels for traders here.
Let me ask you a broader market question, Karen, because Apple, as I tweeted out, is 10% or more of 16 major ETFs. The XLK ETF, one of the most widely owned, is 71 stocks. Apple is 20% up if, for some reason ever, Apple starts to go down.
Ever. Yes. I think that.
Never's a long time.
Right. Never's a long time. I mean,
Apple seems to be the horse And the market's
Don't disagree.
the card.
Right. I mean, for a long time, Cisco was the proxy for the market, right? Remember that several years ago was Cisco.
GE.
I think, right. Well, yeah, that was a longer time ago. But so I think now Apple is kind of the proxy for the market. It's so widely held, retail, institutional. I think that this is good for the market, no question. I think to get the market to continue to go higher, I think we need to see Facebook and Google and, some industrials do well also.
Really quick, Apple's move was 33% of the performance of the triple Qs off that June low, which rallied 30%. Decide what that means for the market. I don't think it's great.